Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show or watching if that's the case. We got a great guest today, Matt Faircloth, who I actually know personally, and we've actually had him on a podcast about 5 years ago. So a lot of similar common background, and in particularly like where we're from, and it's just kind of a rare deal. So you guys are in for a treat today. This is definitely one you want to pay attention to, take notes. If you're driving, just, you'll get the show notes later, but make sure you pay attention to this one, guys. Okay. Particularly if you're serious about investing in multifamily. All right. So first off, Matt, thanks for joining us again, man. It's been a long time and I really appreciate you taking your time to share your knowledge and skills with everybody,
Thank you, Gary. Good talking to you today, man. I appreciate you having me on again.
You got it. So, hey, if you wouldn't mind, I always like to start with a little bit of, backstory. Can you describe to people, like, what was your pivotal moment? What got you into real estate investing? And because it's always a good story, plus it provides context, and we can dig into some of what you're doing today too.
It's pretty, it's maybe common for some of your other listeners that are into real estate investing. My wife, maybe not their wife did it, but my wife read Rich Dad Poor Dad, and had read it before we had met. And then when we started dating, very soon after we were dating, she put it in my hand, and said, "Hey, you need to read this," because she knew I wasn't happy with my job. I kind of didn't really see where things were going to go. Wanted to get in real estate, and you just saw that real estate investing was a good thing for us to get into together as a couple, and so we did. And so we started investing in real estate together. We were dating, and when we got married, I quit my job, and I just really fell in love with it, and have been investing in real estate full time since 2005.
Nice. Well, we'll have to point something out for everybody that can't watch this. I'm looking at there's a Hokies banner in the background, and one of my best friend's wife's uncle was Billy Height, the running back coach for the Hokies. He retired.
Okay,
I think,
there
briefly,
you go.
But
I heard him. Yeah,
got to go to all the games, standing on the sideline. His son was a cheerleader. He was the leader, the guy that ran on the field with the flag. When they played the Sandman. So I know I'm getting nostalgic here.
Boy. Yeah, that's something else. They enter Sandman, that'll just vibrate the whole stadium when they play that, man. It's a great tune. And Metallica is playing live at Lane Stadium this next year. I'm going to try and get down there for that, because how great would it be to have them play that song in person at the stadium. So but I'm a Hokie. I'm a Hokie proud. I went to school for engineering because my people that I knew growing up told me that, "Hey man, you're good at math and science, you should be an engineer." And sure, I'd been to what an engineer was and did. I just trusted grown-ups, right? So they said, "Sure, that's what you should do." So I did. So I went to Virginia Tech for engineering, and I ended up getting a job in sales because I realized that engineers weren't as extroverted as I wanted to be, and I wanted to, I was good at math and science, but also did enjoy people and didn't want to sit in a cubicle all day. So I got a job in technical sales that I enjoyed for a bit, but there seemed to be more in me than what that job was bringing out. And so that's how Liz saw that. And she recommended I check out Rich Dad Poor Dad, probably 22, 23 years ago, and changed my life.
Yeah. Well, that's awesome. And he was, I should probably remember, he was a big influence on me too. And I started investing.
On many.
Oh, yeah. Yep. I got his first book. And then I think I got like 27 books from him and other people he co-authored with over the years. But Rich Dad, Poor Dad, Cash Flow Quadrant. And I took the program back then. It was on cassettes, but and I was already investing. What it really did is it brought into focus the real key principles of how to be successful in investing, but also in building business. Because I'm sure, like you move on and you leverage the real estate foundation to build other businesses related to real estate. And then you're serving other people. Then you're following Zig Ziglar's principle: help other people get what they want. You'll get plenty of what you want. So, could take us down that journey a little bit further. So, what was your first property, multifamily, single family, or what was that like?
First property was one that I lived in. That's when I read Rich Dad Poor Dad. I was renting a house as many, mid 20 somethings do, right? And my landlord was telling us, hey, you guys got to move because I'm going to be selling the house. And I tried to buy the house that I was in, and somebody beat me to it and all that. And so the realtor that had listed the house said, hey, let me help you. It took me under his wing and kind of showed me how much I needed to have in savings, and helped me out a lot. And then took me out and about, and we looked at a bunch of houses, and I found one that I loved in just outside of Philly in a little town called Conshohocken. And it was a 3-bedroom, 2-bath. Paid 150K for it back then, which was a good, that's what probably was like the top of my affordability range in the early 2000s. And my 2 buddies that were renting with me in the next town over moved in with me. And just not thinking about the equation. This is way before they called this thing a house hack or whatever. Just got 2 roommates, and I knew it would be kind of a rental property. Maybe it would work out. These guys started paying me $500 a month, and my mortgage was 940. And so I was making 60
Nice.
bucks and living there for free, and I had a good job at the time, you know?
Yeah.
And so that opened up my eyes right there. That was my first rental property. Was I lived in it. And in about 2 years, I paid off all my student loans. I paid off all my credit cards, got myself bad debt free, and saved up a nice little war chest of money as well for when Liz and I got married. I was able to, quit my job, and her and I just live below our means and get involved. And, our first property we didn't live in was a duplex just in one of the neighborhoods of Philly, and then renovated that, rented it out for a year, sold it, and did a 1031 exchange into 2 quadruplex, 2 quads, that we renovated and leased out and did well with. And then that was kind of the snowball moment right there. And that was in 2000, I don't know, like 6-ish, right after we got married in
Okay.
05. So probably a year or so after we got married, we started acquiring in New Jersey and we bought a bunch of those quadruplexes. There was on a whole strip of them, right? There was a like a block that was all quads. And by the
Right.
time within 5 years, we owned 5 of those properties,
Yeah.
of those quads. And we ended up selling them up to somebody who viewed that to be a 20-unit apartment complex. And it kind of sort of is, even though they're separate tax parcels. So that was how that was a big pivotal moment for us, and a big leg up. Got us a lot of attention, got us a lot of new investors, and then we just kept motoring down from there.
Well, what's interesting is, of course, I'm, from Maryland, lived in Baltimore, Columbia,
Yeah.
lived in Pittsburgh, PA, my nieces in Philly, and you got in right at the right time. I mean, there was a big, it became very attractive to millennials. Philly became very attractive to
Yeah.
millennials, and it drove up the prices. And for example, I don't know what you paid for your fourplexes, but I bet they're a fraction of what they're going for now.
I
My
have to
niece,
look. I don't know.
yeah,
We paid a lot because we bought before it's interesting to say, Gary, but like, real estate doesn't always go up. It does go up, down a little bit,
yeah.
sideways sometimes. We bought them like before the crash. We bought them in '06, I believe.
Okay. Yeah.
And just, I mean, this is like crazy mortgage rates that you could get back in the day. We
Right.
bought them on a 80% LTV first mortgage, a 95% LTV second. Okay. So 5% down, that's where the 1031 money went, is into that 5%, and allowed me to buy 2 of them. And then I got the seller to do a seller assist on the closing costs. So I rolled in there with nothing but a smile at closing, and my 1031 money, right? And the first mortgages were neg am. They were negative amortization. You remember those from back in the
Oh
day,
yeah.
right?
Oh yeah.
Where guys, there's like weapons of mass destruction. But at the end of the day, like the way that it was set up, because real estate always goes up in value, doesn't it? Right. And so
Yeah.
your principal would go up a little bit each month, because you
Mhm.
weren't paying the entire interest that was due on the loan. Like, say, for example, the
Mhm.
loan interest was $1,000 a month. You'd pay $600 a month, and then your principal would go up by $400 every month.
Yeah.
And if the property value goes up by 15,000 and your loan goes up by 5,000 a year, then hey, you're all good. But what if the market goes
Mhm.
stagnant? What if it goes down? Which it did.
Mm-hmm.
In '07, rightfully so, because of all those crazy mortgages that were out there, and you can't do
Yeah.
that kind of stuff anymore. But hey, we were young, naive, we ended up
Mm-hmm.
we didn't miss a payment. We didn't lose those properties or anything like that. We just kept making our payments and eventually refied out of those awful debt or mortgages and got into something
Yeah.
more stable in that. And I've not looked back to say I paid I'll tell you, I paid 319 per building, 319,000
Okay.
per. I'd be
Yeah.
willing to bet that they're trading for way over, like probably close to five or so now.
Yeah.
Because that's just what, it's Jersey, and it's the cost of rent is very high there. So my
Yep.
bet is that they're way up. But hey, I don't look back. I rarely look to see what a property that I used to own is worth anymore, because who cares? It's not a good thing to
Yeah.
do. You're only going to be,
Yeah.
it's only going to make you happy or sad, but it's not going to be anything you can control. So I
Correct.
rarely look back to see what things are selling for.
Yeah. Yeah. It's good philosophy. I just read this last night in a Wayne Dyer book. The analogy was in a being in a boat. If you notice, the wake is always behind the boat, and the wake never drives the boat. And if you're driving the boat, you damn well better be looking forward the way the boat's going. It's just there's just an analogy, but it's a great principle is, look at where you're going and you'll go where you're looking, you know.
Yeah.
So
And I
if you
mean,
look at what, yeah,
when I sold those properties, it was time for Liz and I to sell. It was a profitable
hmm
time to sell. It was a moment to release and let go.
yeah,
I know that Kiyosaki talks about this, and a lot of, folks that are real estate talking heads and stuff like talk about never selling and stuff like that. That's all well and good, but at some point, properties
mhm,
do need work. And so if you're planning on holding forever, you better have a bunch of money set aside for capital
yep,
improvements and everything like that. And sometimes it's good to take some of your equity off the table, because you can't refi to 100% loan to value. So you're going to have
right,
some unrealized gains that are just sitting there in the property value that'd be nice to pull out and roll up into the next deal through 1031s and stuff like that, which Liz and I have been able to do. So I believe in holding until it makes sense, until it's time to graduate, let's call
yeah,
this thing a big school. And so I think we should all start school in real estate investing on the small side, duplex, triplex, quadruplex. If you can afford to make your lifestyle change to live in the property, all the better. I think that's
yeah,
the best way for most people to get into the real estate investing game. And then just slowly upgrade over time. I tell people in my student program all the time, double your portfolio every time you do a deal. Think about that,
yeah,
right? Because if I built it out to like 10 units and I do a deal, maybe then I'm at 20. And then
yeah,
then I'm going to school of hard knocks and learning what it is to own 20 units and learning what it is to landlord 20 units and figuring out the hacks and figuring out the systemizations of it. And when next time I do a deal, all right, I'm going to go tackle a little bit. I'm going to go after a little bit of a bigger linebacker here, and I'm going to get myself another 20 unit. And then I'm at 40,
yeah,
right? And then it cycles up. And I'm not one that believes you should get into the game and make a big splash and go buy yourself a 100 unit unless you're a 100% passive investor and an LP in somebody else's deal. Then you could do that. But I am a grow organically into this real estate investing
yeah.
space kind of person. And it just sometimes it makes sense to hold, and sometimes you should just sell up so you can try on something a little bit bigger.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions, because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestatewithgarywilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Yeah. I know one of our mastermind group members, I guess so, I'll just get first name Andrew. He was an engineer too, just like us. And his first
So
property right
many.
out of the gate, I remember he told me it was 94 units. I'm like, how
Oof.
did what and it was in California too, of all places. But he took it down, and then he kind of formed a little informal syndication group, a lot of the other guys, and started buying around the country. But for me, it was all just like you. It started off. It was actually my first. It was a 4-bedroom, 2-bathroom unit in Virginia Beach, Virginia, and then my first non-lived-in place. We house hacked that too. We rented out 2 other rooms.
Yeah.
Their rents paid our bills. But later on, I bought a pair of fourplexes. That was my first foray out on my own. Um, and if it'll make more sense, you understand. My college roommate's dad was a big investor, and he helped us get the right mindset right out of college. So I didn't have that natural fear that most people would have, or I had some instincts. But in any case, I also I had a lot of fourplexes, and what I realized, Matt, is even if one of them is vacant for a month, the other three, I'm still positive. I'm still in the black, making money.
Yeah.
And because it's 4 units or less, I still get all the residential rates and occupation rules and whatever,
Yeah.
the occupancy rules and
There are
insurance.
so many different ways to play this game. And I know people too, like your student Andrew, your mastermind member or whatever, that bought a 94 unit and made it work. I know people that bought properties like that and didn't know what they were doing and wrapped it around a tree, and screwed it up. And I
Yeah,
also know people that bought single family homes and messed it up too, right? So I'm not saying that, and I don't wish that upon anybody, but just if you don't get the right advice and get the right groups and get in the right systems, then you certainly can. But bottom line, there's a million different ways. Before you and I aired, we were talking about midterm rentals versus short-term
yeah,
rentals and stuff like that here. There's so many different ways to invest in real estate. And that's why I love the game of real estate, but also caution anybody
yep,
that you got to be careful and stay focused and not get FOMO and not get shiny object syndrome when you go on a podcast and you hear somebody like me or if I go on somebody else's show or for me hosting the best ever show, because I'm now host of best ever now, Gary.
oh,
If
cool,
somebody comes
congratulations.
on to hears me on the best ever show and I have somebody that owns a portfolio of, let's say, self-storage, right? I'm not in
Yeah,
self-storage. And so that sounds interesting, but that does not mean that we need to pivot so frequently. The successful
mhm,
people that I know in real estate investing are typically good at one thing. Like Joe Fairless, the founder of Best Ever,
yep,
is just all he does is multifamily. That's it. That's all he does. Multifamily,
yep,
value add apartment buildings. The end. No self storage, no flex industrial. And it's not those things are bad. But if you look at
right,
other companies, that have built into the stratosphere of size and of scale and have employed a lot of people and have great visions, and you can tell are very sustainable companies. They're going to be around forever. These are companies
yeah,
that are focused on single asset classes, maybe two, but mostly single asset classes.
yeah.
So,
I agree. I've done the same. I definitely simplified over the years, but I want to go back. You mentioned your students. You have a program.
mhm.
Um, can you touch on that a little bit? What does it look like? Where
you
do
know,
people? Because you got some great life
I
lessons to
didn't want to
share.
do it, to be straight, Garrett. But when I started doing a lot of work with BiggerPockets and I wrote my book and I started doing
Mhm.
podcasting and everything like that, I am an operator of real estate. That's what we do as our company. It's what DeRosa Group does. But as you start doing a lot of these things appearing on the BiggerPockets podcast and these things come out, there are people that like want you to throw down a rope. And to help them up a bit. And that's why I started a YouTube channel. It's free. You can go to YouTube and just type in DeRosa Group, DEROSA, and you find our YouTube channel. It's got like 400 or 500 videos out there now. And that's all free. And so I wanted to provide the means to give people some guidance that I didn't have. Because when I got started in 2005, Gary, there was no YouTube, there was no nothing.
Yeah.
You'd go to RIAs and I'd go to RIA clubs and meet people that were a few steps ahead of me and just ask them advice. Like, hey man, how do I find the right tenants? How do I find the
Hmm.
right deal? How do I get financing? These people would take you under the wing, help you out. Fine. I wanted to do a bit of a give back there. And so we decided to obviously ton of free stuff. And our website has a ginormous amount of free stuff that people can get. So most of what we do is free for our education programs. There are means if you need our direct one-on-one time, then there is a minor cost to it. I'm talking hundreds, not thousands per month, right? Couple $100 a month, you can be in masterminds to pick our brain and meet with me and my team and have access to hours worth of video content and stuff like that. Because I wanted to create something, Gary, that like I would have subscribed to when I was a rising, and I still am a growing real estate investor. But when I was a rising real estate investor, just getting into the game, I would have wanted to have direct access to somebody that's got a sustainable, established business that's made a bunch of mistakes and is willing to give me guidance to keep me away from those mistakes that they made. Hey, that's me. I've made a ton of mistakes, and I'm willing to keep people. I do my best to stop anybody in our program, whether watching YouTube or in our accelerator program, keep them away from the mistakes that I've made. Right. So I wanted that, and I wanted like the tools that you need to build a business. Cause I wanted to be like, well, how do I underwrite deals? And what software do you use? Well, okay, how about I just give people our underwriting tool? Here you go. Here it is. Part of it, there's a free one on my website, and there's one that's in our accelerator program that's more robust. Same thing. It's just Excel, but it's our Excel spreadsheets that we use, that we give away. That and templates on how to present deals to investors. The right way, the wrong way to raise money, the illegal way to raise money from investors. So don't do that. And then the right way, that I've been taught by attorneys on how to do it wrong and how to get yourself in trouble raising money and how to do it the right way. So all that is I wished I had learned, earlier in the game, and it would have helped me scale. So, and more importantly, above all else, Gary, having a mentor sitting over. I mean, when I first got going, we bought that portfolio of 4 units I told you about, right? So I'd owned a couple single family homes, and I bought those 4 units, all good to go. Everything was starting to move real nice for Matt and Liz Faircloth. Then what do we do? You would think, go buy more residential multifamily real estate. I go out there like a knucklehead and go buy an office building, right? Had nothing to do. It is like buying a grapefruit when I own a portfolio of car tires. It had nothing to do with the other thing. And then I had to drop what I was doing in all this multifamily and learn how to run an office building as well. If I had a good mentor or a program or something that I was a part of that would have said, whoa, foul ball, stop, don't do that. And they would have coached me about like, hey, you should probably just stay in your lane. Somebody that's been around the block a few times. And so that's why we decided to start a program, not because I want to, make lots and lots and lots of money as an educator. I want to make enough for that it's worth our time to do it, because we are still primarily an acquisitions company. But I wanted to make something so I could help a leg up. Above my head, Gary, it says transforming lives through real estate. I want to help more landlords make things better by being landlords with what they do. Landlords get an awful name in the world, but most folks, there's a few bad apples, but for the most part, landlords are great people just trying to get by and feed their family and build their wealth through real estate, just like the rest of us, right? I want to help landlords build sustainable businesses that they can give back and help others and create great livelihood for their tenants, the residents, excuse me. I don't like the word tenants anymore. The residents that live there, because that's their home. Let's call it that. They're not just a number, not just a door. So anyway, that's why I did it. That's why we built what we built.
Well, the other thing too is what I noticed. I started teaching probably 20 years ago, and it really was pretty accidental. But I really liked it. I just found out something about myself. It's just, I wish I'd have known it before. I would have done it sooner, but I've been doing it ever since. And I still wake up today just as excited as I did 20 years ago. I love doing it. But one of the benefits I didn't anticipate in the beginning was you actually have a network of people you're teaching that are potential partners for you, right? And you know them and you taught them. So it's like, boy, what a high caliber prospect for partnering with people. It's just an amazing. So I love it for that regard too, but it is very fulfilling, and it does satisfy Zig Ziglar's lesson, helping enough other people get what they want. You'll get plenty of what you want,
I'll say this. There are other student programs out there that are like in disguise, meaning like, hey, pay me a lot, and we don't charge this kind of money, but pay me like 4 or 5 figure check, and I will teach you how to go out and find real estate in using my methodology, so that you can find a deal that is too large for you to do, so you can bring it back to me, and I'll do with you. There are a ton of gurus out there that have programs
Right.
like that where pay me a lot of money so you can go find me a deal, right? That is not
Yeah.
us. That's not what we do.
Right.
We want people to build their own businesses, not become little DeRosa minions that are out there doing,
Yeah.
finding us opportunities. There's plenty of gurus out there that claim that they own 4 or 5, 6,000 units. And really what's happened is they've taught a bunch of students to go find them deals so that they've got a little piece,
Right.
little slice in 4 to 5,000 units that their students found for them. We're an
Yeah.
alternative program to that. I certainly will not let my students fail. And so I've stepped in to help them out. And we've done slight joint venture partnerships, but it's always their deal. And for the most part, our students that have closed opportunities took it to closing on their own without me having to step in aside from a mentor. And that's our goal,
Yeah.
is that we don't have to help. We don't have to take it over in JV with them, but I will not let them fail.
Right.
So if
Yeah.
they need our help or need our involvement, we'll figure out a win-win,
Well, that's what I've always liked about you. It's education based. You lead with education, where the ones you described earlier, it's a sales. We're all making sales, obviously, we're making a profit, but they lead with making a sale. Sell that damn thing, no matter what. I mean, I've had people come to me telling me, I'm not going to name any names here, obviously, but they were told from these quote unquote coaches.
hmm
They're not coaches. Well, they technically are, but they're not. You're not getting the
The
real guru.
primary
You're getting
income is from teaching. And I'm very cautious of
yes,
anyone whose primary income is teaching versus
yeah,
someone whose primary income is doing, right?
exactly.
But yeah,
Yeah.
keep going,
Yeah, but
right?
they were telling me stories like they were told them to sell their boats, sell their cars, do every cash in their 401ks to pay for the program. I'm like,
Oof.
no,
Put it on a credit
that's a
card. Yeah.
huge mistake. Yeah.
Put
So
$15,000 for my program on a credit card. I was at a RIA when I
mhm,
first got started. I used to run the South Jersey RIA.
mhm,
I ran their Princeton chapter anyway. Um,
mhm,
and one of these guru dudes came through, and I won't name them, but they weren't even multifamily. They were teaching some other concept. And this guy sitting in the audience, man, had lost his job. He was on unemployment, and the guru was selling a program for 10 grand, and this guy had his credit card out. And I'm like, what are you doing, man? No,
yeah,
put it away. And I talked him out of it.
yeah,
I was like, there's no way, you don't need to do this. He's like, well,
right,
maybe this will kickstart my investing career and this will be, it's like, don't take the 10 grand, keep it in your
yeah,
pocket. He was going to, put it on he was going to borrow the money. Right.
right,
In that. And I don't believe in any of those things. I think that first of all, you got that kind of money, you could damn near do a deal with 10 grand,
yeah,
a little bit more than
mhm,
that. I'm dating myself, but back when I first got started, a lot of the C-class real estate out there, and especially in markets that were really, really on the emerging or got hammered hard during the financial crisis,
mhm,
you could buy row homes, in downtown for like 30 grand, 40 grand. It's like, well, why don't you go
yep,
find a private lender? Guess what? They're in the room, right? They're also in this
yep,
room. Go find a private lender and then get them to lend you 20 grand. And you take that 10 grand you got and buy that deal and maybe fix it up
yeah,
yourself with your own two hands, whatever it is. Get in there. And like I said, I'd rather see people get to doing versus just,
yeah,
bowing at a shrine to learn from somebody who, yeah, you might as well just get out there and learn. I mean, honestly, doing is the best educator in the world.
yep,
Get out there and put get your hands dirty and start working in the business to do a deal and you'll learn. And I mean, that's what we teach in our
yeah,
program. Get out there and find something. I'm not going to give you the keys to
yeah,
success. I'm going to put my foot up your butt and teach you to get out there and find something on your own and let that deal that
right,
you find be your educator. And I'll just stop you from messing it up. How about that? You know?
yeah. What are is the accelerator program, is it broken down into like 3 or 5 or 7 basic steps? Like what's the
Well,
process when someone gets in, start to getting into deals? What does that look like?
here's been my philosophy, and this has to do with being married to somebody who's very smart and has her master's in social work and has taught me about the human psyche, and about the way that we are wired as people.
Hmm.
And I think that we're the only folks that really teach it this way about real estate investing, in that like there are personality types that it takes to be successful in real estate investing. And so we talk about helping people figure out which of the 4 personality types we came up with they are, and then leaning into those only. Like, so for me, I'm what we call the money. I am the attention for the company. I go on podcasts like yours and chat with people like you. I'm maybe more of an extrovert, maybe more of an optimist, maybe more chatty, and I go out there and chat with people like you and get attention to my company and get eyeballs to DeRosa Group that can get converted into either partners or investors, right? Then there's a hunter that goes and finds deals. They are more, they are a better negotiator. They are someone who's very, very thick-skinned. They can get told no a lot and keep going.
Yeah.
And they are someone who is probably a good salesperson because they can convince a broker to take them seriously, where others may, be a little more skittish around something like that. Keep going. Then you got it's funny, Gary, even though I have a background in engineering, I hate underwriting. I don't like Excel spreadsheets. I like the numbers enough to understand them and whatnot, but I don't have the patience for analysis of complex real estate opportunities. And so I believe that there is a personality that we titled the brain, which is an analyst. Some would call an underwriter, and there are people that are a little more introverted, maybe a little more risk averse, and maybe a little bit more analytical, that they can just sit and weigh out all the ifs and that's on a deal and come up with a viable, sustainable, followable, profitable business plan for a complex. You might not need a written out long-term business plan for a single family home. I get that. We all can muddle through that. But show me like a 100 unit or a 30 unit or a 10 unit. Right. You might need someone to write out, well, when are we going to budget for replacing the roofs? When are we going to budget for replacing the windows and the carpet? What are we going to raise rents up to? Where's the data that shows that the market will support the rents that I want to raise it to? What if my interest rates go up? What if my tax rate goes up? When am I going to sell? When am I going to refinance? These are all parts of a business plan. The underwriter creates all these things, or the brain does. And the last one is the hammer, and they're the person that actually goes forth and makes those things happen. They're the implementer, because without a great plan with a bunch of and a great property, and it could be the worst investment deal ever because it's not properly managed. I'm not talking about property manager. I'm not talking about your property manager. I'm talking about your asset manager, because I've seen too many people, Gary, make the mistake of buying real estate and assume that the property manager is going to do everything for me after closing, and I can wash my hands and cross my arms and wait for the checks to come in that the property manager is going to send me. You find out the hard way that's not true, that the property manager is good. They have a job, but they're also not an owner, and they're not going to think like an owner, right? They're going to just go and spend your money if you let them do it. And so the asset manager is one that is the owner's voice to the property management company, right? And so those 4 elements are what our student program is based on. And there are 10, 15 hours per element on each of those in video modules in our student program. Plus, there is a talking head on my team for each of those different. I'm not all of them. I'm one. I'm the money. But there's also other elements of the student program that bring other voices to the table. So
yeah. Well, that sounds good. I tell you what, and we're going to get short on time here, but I want to kind of take it forward to like today. What are you seeing out there? Any particular projects you're working on? And I've are you doing syndications that I guess the way we normally see them out there, where you're going outside, so you have to follow all those rules. You're doing more internal type fundraisers, or kind of fill us in on what you're doing today.
Yeah, sure. We've syndicated about 65 million worth of investor equity since our inception. And no, we actually have 65 million under management right now. Excuse me. We've returned a lot of that, a lot of other dollars already through full cycle deals and everything. So we are currently, syndicating deals through, small checks from investors or mid-sized checks for those that want to join us on our ventures. And we are gravitating more towards new build or major gut reno. That's where I see the market at right now, Gare. Unfortunately, I don't see big opportunities in like little tweaks, value add, existing multifamily, kind of buying a property for X and hoping I can just through some minor adjustments, making it worth a lot more. It's called forced appreciation. I don't see that as much anymore. What I see happening now is you got to roll your sleeves up and do major work to make things work. So we are building 3 apartment buildings right now. So I like the new construction game. We'll probably see DeRosa doing more of that. I also like the
Nice.
major gut reno game. I'm not talking about just little tweaks while people are in the apartments. I'm talking about taking something vacant, gutting it, turning it up, and making something amazing that feels all new, because it is, and putting that on the market. So we're doing more and more of that. We also have a fund. We have a debt fund that issues hard money, and just pays investors a monthly check in distributions. Very liquid. It's very liquid. They can get their money back whenever they want it. And they can even compound their returns if they want to. So those are things. That's really what we're leaning into now. We'll still do value add deals if they come up. I just don't feel like the market, Gary, has corrected to the degree that it should with regards to existing multifamily that's out there.
Yeah, I think that day's coming. The thing is we can't tell you when. I mean, look at the last recession. We were calling for it for most people for 5 years before it hit in 2002. We're like, we got a big problem brewing here. But it was 2007 before it finally really busted. And even before that, Barron's was actually calling for it as early as 1999, and everybody thought he was nuts,
Hmm.
And but boy, he was right. He did the math. He said this is not good. The entire mortgage brokerage industry came out, for two reasons. Number one, when we decided to package our loans and sell them on Wall Street in the 70s, and then in the 90s, the administration in charge at the time lowered the standards for people getting loans. So then they created that underwriters. They created a third industry, and when the bottom dropped out, 1/3 of them were gone by the end of fall. That last quarter of 2007, it was disastrous. But in any case, so back to this, you know, I think we're going
And,
another
and
one coming.
I'll put a cap on it for you with you. I don't predict history doesn't repeat itself directly, but it kind of says around the same thing, maybe in a little different language, or there's there are similarities in historical items, right? So I don't predict a financial meltdown like we saw in '07. I think that was a one-time occurrence. Again, there's a lot of things like Dodd-Frank and rules that have been put in to prevent mortgage-backed securities from behaving the way that they did before, right? So I don't think that that's there. There's certainly other things that are causing certain strains on the economy. I interviewed a guy on Best Ever a couple of weeks ago, Jeremy Roll, who I highly respect. And he was straight up like, it just has to happen, a recession, I mean, you made me want to crawl under my bed, but yeah, I do think that we're due for a bit of an economic correction to this, stock market and across the board, a bit of a bubbleification going on out there and a slowdown. So it doesn't mean you can't make money. I think a lot of money's made in markets like this. And I'm not talking blood in the streets. I'm thinking it's one of these things where you might see a recession that'll slow down job growth, that'll slow down occupancy on multifamily. People aren't thinking about that. But what if like a large portion of your tenants lose their job and can't afford to pay the rent anymore? What if that happens along with some other economic slowdowns and everything like that? People aren't expecting that. They're thinking, oh, multifamily values will just crash because interest rates or because it's propped up or whatever. But if tenant income becomes soft, you could certainly have a major slowdown in the real estate market, in the rental side anyway.
Well, it's just there's always opportunity, and you're right. I mean, in the last recession, the properties didn't disappear; they just changed hands. And you just got to decide, what role you're going to play in that whole deal. And
which hands are you going to be?
Yeah, that's right. Hey, I want to ask you this. So I wrote down a few things for the DeRosa Group, the Best Ever Podcast, and the Accelerator Program. How can people look into this more? Is there one central website, or I mean, let's rattle these off. And
just
we'll put them in the show notes
DeRosaGroup.com.
too.
They can, after they listen to your show, they can go and listen to me on Best Ever. I broadcast every Friday. My shows release on Friday. So if it is a Friday, guys, hey, good news. It's a fresh episode of me on the Best Ever podcast hosting on that show, all kinds of different folks. And then you can always go to DeRosa Group, DEROSA, DeRosaGroup.com and learn more about our company and what we're up to.
Okay, good. And
including
they
our
can get information on the
accelerators there. All the free stuff I
Perfect.
talked about, tons of free tools that you can use as a free underwriting software, free market finding tool on there. There is a superpower assessment. So I talked about I talked about the real estate personalities. You might think you know what you are, but if you want to take a free assessment that'll tell you in about 5 minutes what your real estate personality is, that's all out there for free too at DeRosaGroup.com.
That's awesome. Well, I appreciate it. Everybody listening, just remember, um, we do these podcasts as a community service. Matt and I don't actually make any money directly from this. Yeah, we network. That's what we're getting at. Is we're getting you contacts. We get to keep up with each other. But for you get a lot of good free content. You can go to the YouTube channel. Is it the DeRosa on YouTube also, Matt?
Yeah, just type in DeRosa, DeRosa,
Excellent.
DeRosa Group on YouTube, and you'll see our channel there.
Yeah. And we, ironically, I in addition to the podcast, I teach a class called Monday Night Live every Monday at 7. So we're done before the football starts.
There you go.
In any case, I had a student on last night, brand spanking new, and I had an expert come on and talk about cost segregation, AKA, accelerated depreciation, way over this kid's head. But he said, I want to know where to learn. And Eric Oliver, who was the engineer, by the way, he's got a great business for cost segregation, took the time to tell this guy what to do. And it all started with education. Get the right education, get the right information, take the right action. You're going to get results. So he was ready to head out there and pay something for some big program and go to a hard money lender. I'm like, look, just stop for a second. We need to go focus on the fundamentals. So when you head out of there, you're swinging the right bat at the right ball at the right time, instead of just blindly swinging. So I'm going to send them to you and to the accelerator program. I like the way you do it. And if everybody listening, leave a review, man. Your reviews are our like fuel that keeps the podcast business going. Your reviews help us go. We really appreciate your reviews and listen to Matt's best ever podcast too. Who knows? Maybe Matt will invite me on to be guest one day, and I'll go on there and
they tell me who I'm interviewing, but yeah, I'm glad to submit you. So listen for Gary soon on the Best Ever Show.
There you go. Well, Matt, thanks again for everybody listening. Thank you. We will see you on the next Massive Passive Cash Flow podcast. In the meantime, take care of yourselves, and God bless you and your loved ones.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.